Hello and welcome to episode 2 of The Rate Stuff, your essential guide to all things mortgage. My name's Jack Izzard and I'm on hosting duties today, and I'm pleased to say that I'm joined by the CEO of Empowered Mortgages, Stuart Cheetham. Stuart, welcome.
Thanks for having me. Delighted to be here.
Well, let's see if you still feel so chipper at the end of the show. We've got a lot to cover today. Since we spoke to you last at the end of January, we've had a base rate cut from the Bank of England. We've also seen several major mortgage lenders come out with quite aggressive cuts in their interest rates. We're now seeing interest rates starting with a 3, the first time we've seen that in ages. So stay with us as we unpick that and answer a viewer's question here on The Rate Stuff. Okay, so let's dive in and take the temperature of the market. At the start of February, the Bank of England's Monetary Policy Committee voted to cut the base rate from 4.75 to 4.5%. Not a great surprise, we were expecting that, but the market has responded. Several major lenders have cut their rates, and some are now offering mortgage interest rates that start with a 3, the first time we've gone below 4% since November last year. Stuart, tell me about that response from the lenders. Were you surprised at how quickly they responded?
I'm not necessarily the speed of their response, but I was probably a little surprised that we've broken the 4%. And that is because, that is really quite punchy pricing. It's below the swap rates. I think it's a clear sign that those lenders are really looking to make sure the flow of business is coming in the door, to keep the lights on, to cover their cost base. They're making sure they get that flow in. And so I was a little surprised. But then, and all the brokers watching this program will be shouting out already, wait a minute, what about those arrangement fees and some of those products, yeah? Well, some of them are pretty punchy. Doesn't mean they're a bad product, but maybe not sourcing as well as that headline rate would suggest. But I think we can all see there's some very good products out there as well. Normal arrangement fees, sub 4%, and I'm sure they're going to get a lot of traction in the market over the next few days.
They are genuine rates, though, aren't
Completely. They're genuine rates, and we should really look at this as a positive news story for the marketplace. It's hit the press a lot. It's going to give consumers confidence. That's what we really want in the marketplace. So I think we should embrace them going forward as being good moves. But, as I say, they're pretty punchy rates. They won't be making much money on that.
Well, let's just scroll back to the Bank of England decision itself. Now, every single member of the Monetary Policy Committee voted to cut rates. 7 out of the 9 wanted to cut by 0.25, but 2 actually wanted to go further. They wanted to cut twice as much off the base rate. So what does that say about where the bank's collective head is?
Yeah, so when you asked, am I surprised about the mortgage rates? I was clearly not surprised, and nor was anybody else surprised that they cut the base rate by 25 basis points. This was highly predicted in the marketplace. And really what that says, that split a vote, they're now talking about how fast should we cut rates. So I think it's common accepted industry points that we should have at least 3 base rate cuts. Certainly if you look at the 2-year swap, it's pricing that in already for 2 years. So I think what we're saying is now is we've had 1, so we're 475 down to 450. Could we be going faster? 2 thought we should, 7 thought we shouldn't. But that's kind of telling us basically those other 2 are coming. We just don't know how quickly yet.
Time to push back the horizon a bit now and start reading the tea leaves with Stuart. So we've seen sub 4% rates now. We should be heading in the direction of more cuts. So when do you think we might see sub 3%?
Well, now let's make sure we're talking about sort of the right things here. So yes, more Bank of England base rate cuts are predicted, and I think it's we can see those coming through. But we've got to remember the swap rates are already pricing that in. So what's the swap? Today, kind of the 2-year swap is around 400 basis points. But wait a minute, we've got sub 4 already. How does that work? So I think what we're seeing at the moment is some very good rates, some very punchy lender rates. I think they're going to be used, become very popular by brokers. How long they last, we'll wait and see. But just because more base rates are coming doesn't mean more mortgage rates will be coming down because they're already priced in. So I don't think we're going to see just this good news carry on. We might actually go back above 4% in not the near too future.
Oh, Stuart, you have rained on my parade there. I was sitting here thinking, happy days, the only way is down now. So you think mortgage interest rates starting with a 2, it could be, what, years away? What's your read on that?
Well, look, I mean, we've got to think about, this question I probably get asked more than any, when are interest rates going to come back to normal?
Yeah.
Yeah, so, well, what's normal anymore? We really don't know. So I think we've got some numbers.
We've got a chart for you.
Yeah.
We love a chart on this.
Excellent. So on this chart, what we're showing you is 2 numbers. One is basically the average of 2 and 5 year rates for the last 10 years, and then also then the base rate over the same period of time. Now, these are not directly correlated to each other, but they tell a really interesting story. And what you can see is actually, as those rates have kind of gone down and then back up in these latter years, what we've also seen is the base rate go down and actually come up. So it looks correlated, albeit they're not strictly correlated to each other. So what does that really mean? What does this really tell us? Well, look, the base rate is giving us an interest rate environment where we might get lower or higher mortgage rates. So if we go back 5 or 6 years, you can see base rate was near 0, and lo and behold, it gave us an environment that allowed a 1% or 2% mortgage rate to exist in that. So now let's fast forward to today. We've got a 450 basis point Bank of England rate, and look, lo and behold, where are our mortgage rates? They're around that environment. So if you want to think about 2%, we've got to think about 12 more rate cuts. 12 more rate cuts. Now, I'm not here to predict the future, and I'm sure all our audience are not here to predict the future, but
You disappoint me, Stuart. I was hoping you brought your crystal ball.
Well, I think, but what we can do, imagine what the probability is of 12 more base rate cuts. And then you can start thinking about an environment where a 2% mortgage could exist.
So, Stuart, I'm sitting here, I'm going to have to cross out my question. When are we going to see 1% rates then?
Yes, well, I think we could do the maths and just add 4 more base rate cuts. But so it's a long, long time away. What is the new normal? The new normal probably is rates beginning with 3. So we've just seen them recently. It's great news. We might not be there for too long, but hopefully as the market becomes more certain, we might see more of them last a bit longer.
Now, the only thing is, certainty is not something we've got a lot of right now. We've got this kind of inflationary spectre on the horizon, both here in the UK, tax rises coming in, Trump in the US, likely to be inflationary. There is no guarantee that we're going to see this kind of ratcheting down of rates that people are starting to kind of assume is going to happen.
Well, you just mentioned we saw on the Bank of England 2 people voting for faster base rate cuts. And that means they want to accelerate down. But if you look at the mood music in the market, as you see, there really isn't a lot of positive news out there at the moment. There's a lot of possibilities. Trump, will there be tariffs? Won't there be tariffs? You know, GDP, as you mentioned. So I would say watch this space. I think over the next few weeks, we're going to see that uncertainty unwind, maybe become more uncertain, maybe more certain. It's definitely going to have an impact on the speed of those base rate cuts. So watch this space.
Well, Stuart, you have sorely let me down. I came here really pumped about the idea of lots more rate cuts, but it sounds like it's not quite as straightforward as that. Final question, let me put you on the spot. Half full or half empty?
Well, I'm always half full, but within the mindset of, well, I think it's great news. I think consumer confidence is sorely needed at this point, and I think these rates would be absolutely helping that. But just a little bit of caution that it might be still a bit of a bumpy ride.
Watch this space. We will watch it and track it with interest on the rate stuff. Okay, now it's my favourite time of the show when I get to put Stuart on the spot. And we have got a question from a viewer. This one is from David Tasker, who's a specialist mortgage advisor, and he's got a cracker for you, Stuart. He asks, when will we get to the point where an analysis of all borrowers' income and expenditure is so detailed that lenders can offer truly bespoke interest rates?
Well, thanks, Dave. Dave and I go a little bit back, unfortunately.
Well, you got to tell me more about that, Stuart.
Yeah, it's a different place
for the director's cut.
Let's not talk about that one. But anyway, look, it's a great question actually, and you know, almost every market in the world, bar this one, does something called dynamic pricing. Not like Oasis. We're not talking about that. We're talking proper regulated dynamic pricing, and in this country we don't. So how does it work at the moment? So if you go and do a PT with a lender, it probably will get some form of dynamic pricing in there, because it's a simple in-house and a separate IT structure. So it's kind of happening a bit behind the scenes already. Now, if you're talking about kind of mainstream purchases and remortgages, clearly it doesn't happen. Empowered is built to deliver this today. When we built the platform, we absolutely designed it to deliver this, because Dave's point here is actually this is in the best interest of the borrower, and it's a fair and reasonable way to do it. Now, the problem why we haven't deployed it, in reality, the problem is sourcing systems are far from dynamic. I mean, probably takes us 3 days to get our rates on there, and brokers clearly need to use sourcing systems for compliance to comply with the FCA. So in reality, the blocker here isn't technology, it's actually in the broker's sales and compliance process, aka sourcing systems.
So it is theoretically possible. You'd love to do it by the sounds of it, but you can't yet.
It's not theoretically possible, it's absolutely possible, and I think it's absolutely in the consumer's best interest. But right now, it's a problem to deliver.
Stuart, thank you very much indeed. And David, thank you for your question. It was a cracker, and there are some Empowered goodies on their way to you. Now, it's worth saying that whatever you do in the mortgage industry, whether you're a broker, an advisor, or a lender, the rate stuff is the show for you. If you've got a question that you've always wanted to ask but were too shy, now is your opportunity. Get in touch via our socials. We'll do our best to answer your question in the next show. For now, thank you very much to Stuart Cheetham from Empowered Mortgages, and do join us for the next episode of The Rate Stuff, the show where mortgages matter.